Hello and welcome to yet another special episode of The Crystal Ball. My guest on the show today is Ridham Desai of Morgan Stanley. Ridham, good to speak to you after a long time. Before I talk about your view on the market, earnings, etc., I want to talk about the new irritant which has cropped up, which is this whole business of the SIT probe into P-notes or originating out of Cayman Islands. You remember a few years back when this whole P-note thing happened, how much havoc it caused in the market. Do you have a sense of how this one might play out and whether it might unleash any kind of damage to sentiment and to foreign flows?
Yeah, hi Udayan, good to be back on your show. I think it's premature for us to react to this, frankly, because it's amongst the many things that the SIT has pointed out in its attempt to stop black money flow. So I think it's too early. I think the government has since then issued a clarification that nobody should jump to any conclusions, that any action will be taken after careful thought. I think the government had the experience with the MAT issue, that dealing with this in a casual fashion can create a lot of impact on sentiment. So I think we should expect from the way the government rectified the problems with the MAT issue that this time around they will be a lot more careful before any actions are taken. But overall, I think it's too early for us to actually react to this.
Is it a potential irritant, though? I mean, would you expect worried calls from clients? Is it something that will engage your attention as a brokerage house over the next couple of days? Would you expect to hear any voices of consternation from your clients?
No, I don't think so. They're not immediately. I think people will like to see what details are following up. Just the mention of P-notes as a potential source for black money, I don't think is going to worry too many people, especially because I think a lot of them actually have credible flows that are coming through. So I don't think they need to worry. Those who may not have credible flows may have to get worried, and they may actually not be part of our client base. So I expect any major panic from our client base.
You've been quite bullish about the market, and one of the planks of your bullishness is kind of affirmative policy action from New Delhi that you are expecting over the next few quarters and years. In that, the way Parliament has moved this time and the first fears that maybe a key policy thing like GST might get delayed beyond its implementation date, is that causing some worry for your investors that maybe policy action may not be allowed to flow as smoothly as people might have begun to price in?
Well, certainly, I think the logjam in the Parliament is not good news for those who are expecting GST to get passed in this session. I think that's the large-scale expectation of the market, that the GST bill gets passed in this monsoon session. I think it's imperative that it gets passed for the government to meet its 1st April 2016 deadline. If it doesn't get passed in this session, that deadline will look very challenging. So to the extent that the Parliament is not functioning, I think is a cause for worry. Now, as such, if I take a slightly longer-term view, the GST tax law change is a sweeping reform, probably one of the biggest that we've done in 20 years. So whether it happens in April or it happens in June next year is not going to materially change the outlook for India's long-term story. But certainly it could damage sentiment in the short run. So I think we have to be careful about that. And if the government is not able to pull it through in this session, then there could be some risk to near-term share prices. The long term, I don't think gets affected, even if it gets delayed by 3 or 6 months.
I ask Ridham because, these government policy things have a habit, given our political landscape, of moving in bursts. You will have a lot of action, and then there will be a bunch of assembly elections, and then nothing will happen, and then something will happen in a burst again. I'm sure you're watching the Bihar elections and the few assembly elections which are lined up after that, which are fairly close to call. Do you think, given that, timing is important of how much the government is able to push through right now before the clutch of those assembly elections and how they may turn out?
So, Udayan, I think there are two parts to this. The first part is what is happening on the executive front. Those actions are far more material to say the growth rate that India will experience over the next 12 to 24 months. The second part to this is the legislative changes that have to be pushed through to the Parliament. Those changes are more material from a longer-term perspective. So far as the executive action is not stalled, and I believe it is not, and a lot of the data that we receive suggests that, if anything, executive action actually has been progressing at strong pace. I think the market will be okay because the market will then receive good growth data points, which is what the market cares for. Of course, along the way, the market will also want that some of this legislative agenda gets fixed because that may have an impact for the longer term story. And to that extent, the point that you make on the impending elections in Bihar and the other elections that will come up next year, could become an impediment, especially because, as you point out, Bihar is too close to call. I've not done the analysis on the Bihar elections. I think it's still very early for us to actually take a call on that. But given the aggregation of the opposition in Bihar, it looks like it's going to be an interesting outcome, and it will be a difficult one to call because it will be a binary outcome. So to that extent, of course, these things will come along the way. I think the bottom line point that we should focus on here is that we may be, and that's what my view is, in a 3 to 5 year bull market. Now, along the way, are we going to experience certain patches of uncertainty, certain patches of doubt? Certainly. We went through that. We went through one such rough patch in the months of March, April, and May. We came out of it in the end of June. We may enter into another rough patch if there is a logjam, continuing logjam in the parliament, and if there are adversarial state election results. And I think that those will be opportunities for long-term investors to engage in the market. So I think if we use that as our operating scenario, then we shouldn't worry about these short-term glitches that keep coming along the way. But if your question is, are we going to get them? I think certainly we will get them. We will get a lot of glitches along the way, and share prices will react to those.
Fair enough. Now, let me ask you about this very point that you've raised, the glitches or the rough patches. If you think that we are about to enter one such rough patch at some point, or a glitch, what is more likely to precipitate that glitch? Do you think it will be something local like this logjam in Parliament, SIT probe, etc. that we've discussed so far? Or could the genesis of that be something global, given the kind of very rough data that we're hearing from China, the home sales data in the US? Do you think there could be some global panic which will precipitate that? If you had to put your money on one of the two being the reason for this glitch, which one would you put it on?
Well, if I get anchored to what happened between March and May, it was actually a mixed bag of both, and I think global led local factors. But let's evaluate this, I think, which is a very interesting question that you've asked. I think the world is certainly looking a lot murkier than India is. You point out to the growth in China, the possibility of a Fed rate hike, the problems in Europe. I don't think these are getting solved in a hurry. So they will keep recurring, and they will keep incurring damage to equity share prices along the way. India has done a lot to fix its macro stability risks. We've come a long way from 2013. Fiscal deficit is down, the current account deficit is down, inflation expectations are down, real rates are up. So if you look at what happened in the month of June, particularly when there was a global risk-off on the back of Greece, and then a kind of a China growth scare, India actually behaved like a low beta market. This low beta characteristic actually comes from the fact that India's macro stability is a whole lot better than its peer group, as well as a whole lot better than what it was 2 years ago. The symptom of this macro stability improvement is that domestic flows are very strong. So we have outlined this story a few weeks ago, that we think that we're in the midst or at the beginning of a super cycle in domestic liquidity into equity shares in India. I think that story will play out over the next several months and quarters, and that lends some stability to stock prices in India. So for sure, India will react to global events. I think they are going to probably cause more material corrections than local events, but I think India is going to be a low beta animal in a global sell-off because of its improved macro stability factors, which are now reflected in better saving into equities.
It's time for a break on Crystal Ball. I'll return in just a minute with Ridham Desai of Morgan Stanley. Stay tuned.